In 1 week only, the S&P 500 index alone lost approximately $3.6 trillion in market capitalization due to the escalating trade tensions following the implementation of the new US tariffs. In just a few days, the S&P 500 drops erased all the gains since the US election day. European markets also faced substantial losses, with German DAX index dropping by 3.5% and Spain IBEX 35 declining by 2.7%. The market downturn was largely driven by major concerns over a potential economic slowdown triggered by the newly imposed tariffs. However, the impact extends beyond financial markets. Governments worldwide are reacting strongly to Trump's tariffs measures, which have sparked a global outrage. Mexico, Canada and China have already promised to react, while Europe has threatened to impose counter tariffs of its own. Among this escalating trade conflict, speculations is emerging that Trump may be deliberately fueling market fears to push investors toward US Treasury bonds, thereby increasing their value and reducing yields. However, this does not seem to be the case. In fact, Treasury bonds are not gaining value as shown by this chart. At the same time, the US dollar has weakened its position against the euro, suggesting that investors are moving away from US assets, including treasury bonds, further indicating reduced investor confidence in the US debt securities. Adding to the concerns, crude oil prices are also declining. This is often seen as a warning sign, as oil prices tend to drop when investors anticipate an economic slowdown or recession. When demand weakens, it signals reduced industrial activity, lower consumer spending, and overall economic uncertainty. The falling prices of crude oil suggest that markets are bracing for potential economic turbulence, reinforcing fears that the newly imposed tariffs and trade tensions could have deeper consequences than expected. Moreover, the GDP Now model of the Federal Reserve Bank of Atlanta, which provides real-time estimates of economic growth, has significantly revised its forecast for the first quarter of 2025. On February 19, the model was still projecting a positive 2.3% growth in real GDP. However, by February 28, this estimate was sharply downgraded to a contraction of 1.5%. Yesterday, the same index deepened this pessimism, with the latest forecast predicting a 2.8% decline in GDP for the same period. This scary drop from anticipated growth to a pronounced contraction underscores escalating apprehensions about a potential recession. The term Trumpsession has emerged in discussions, reflecting the concerns that President Trump's recent trade policies, particularly the imposition of new tariffs, are contributing to economic instability. Another important indicator that can help us to better understand the situation is the AAII indicator, which refers to the American Association of Individual Investors Sentiment Survey, which gauges the outlook of individual investors regarding the stock market. This index provides insights into the mood and expectation of retail investors, and it can serve as a barometer for market sentiment. In particular, if we look at the AAII bullish sentiment chart, we see that the bullish sentiment just dropped dramatically down. That means that the percentage of individual investors who are optimistic about the market has decreased. In other words, fewer investors are currently bullish on the market. This index shows a negative peak, falling to its lowest level since 2020 and 2009. This sharp decline mirrors the dynamics already observed during the pandemic, leading many to speculate that this shift in sentiment could trigger another recession. Historically, significant drops in bullish sentiment often signal growing uncertainty and a potential downturn, suggesting that the market may be heading into troubled waters. The current negative sentiment in the market is also reflected by the famous Greed and Fear Index, which currently signals extreme fear. This marks a stark contrast to 1 year ago, when the market was in the opposite state of extreme greed. The sharp shift from optimism to pessimism highlights growing concerns among investors about the future economic conditions. In 2024, the market remained bullish for the majority of the year, with optimism driving steady growth. However, the mood took a significant turn after November following the US elections. Since then, market sentiment has taken a downturn, as investors have grown increasingly concerned about economic and political uncertainty. Of course, also my investments are strongly affected by this market situation. In only 1 week, my position on this ETF tracking the S&P 500 dropped by almost 6%, as shown in my broker app. If we consider the whole portfolio, the capital gain that I earned in 1 year of investing dropped from 17% to 7.6%. All the share of my ETF on the S&P 500 purchased after the US elections in November are way below the current value. So what should I do now with my investments? How should I respond to this market decline? Should I follow the crowd and sell off my positions, hoping to wait for a better market situation before re-entering? Not at all. In fact, I see this market drop as a valuable opportunity for long-term investors like myself. When the market experiences downturns, it often presents a chance to purchase stocks at attractive prices, positioning myself to benefit once the market eventually stabilizes and realigns. Rather than panicking or making reactive decisions, I am sticking to my long-term strategy without trying to time the market. I plan to continue investing steadily, committing to purchase at least €1,000 worth of ETF tracking the S&P 500 every month. This consistent approach allows me to benefit from the dollar cost averaging, a strategy that involves investing a fixed amount at regular intervals regardless of market conditions. The beauty of the dollar cost averaging is that it helps smooth out the impact of market volatility by purchasing more shares when prices are low and fewer shares when the prices are high. Over time, this strategy reduces the impact of short-term market fluctuations and allows me to accumulate investments at a more favorable average price. Patience and a long-term perspective are vital when navigating market fluctuations. While market dips may feel unsettling, they are often a normal part of the investing journey. It's crucial to resist the urge to react impulsively to shorter movements. By sticking to a well-thought-out investment strategy and focusing on the long term, I can weather these fluctuations. Investing with patience allows me to ride out the ups and downs, knowing that market recoveries are often inevitable and long-term growth is driven by consistent, disciplined investing. Ultimately, this mindset will help me achieve my financial goals, even through uncertain times. Well, that's it for today, guys. How are you planning to react to this market turmoil? Do you think I'm using the right approach? Let me know your thoughts in the comments below. And if you're curious to see whether this approach will pay off in the future, make sure to subscribe to the channel as I regularly update my portfolio with all the ups and downs in this series of videos. And if you are interested in buying gold during this period of uncertainty, you might also want to check out this video where I analyze the pros and cons of investing in physical versus digital gold. Alright guys, thanks for watching. I hope you had a good time. See you in the next one. Take care. Bye!